Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky. And we have Jay Hack on the line. He's a certified financial planner with Hack Wealth Management of Raymond James of Associate. And he's a local guy here from the Detroit area. Jay, thanks for coming on the show.
Joel, thank you so much for having me on your show.
All right, so tell us about your unusual career path that took you to your current position.
Yeah, so like you said, I grew up in Michigan, and I had kind of a hobby love of rock climbing and ice climbing, and even throughout college. I went to Emory University. I used to do it on the weekends. When I graduated in the late 90s, I went to work for Bank of America Securities at the height of internet frenzy in their consumer food and beverage department. So we were like the last department to get any type of funding at all, right? It was all going to like pets.com and whatnot. So quickly after that, I went and became a mountaineering guide. I thought, hey, I'm in my early 20s. I want to kind of experience the world. I had all sorts of contracts with the military. I trained CEOs. I took people high altitude ice climbing and rock climbing all over the world, Bolivia, Ecuador, Alaska. And about 6 years after that, there wasn't a lot more I was learning. So I went back to school, got an MBA, and joined my dad, who had been in the financial services industry with his own financial wealth management practice for the last 46 years, and I've been with him for the last 10 years. And in the last 2, I decided to write a book about my dad's experiences and relate it to the markets.
Okay, before we go into that, what was the biggest peak or highest elevation you were ever at?
So I guided, one of the real pleasures, I got to guide a group of 9 individuals, myself and 2 other guides, to the summit of North America, to Mount McKinley, which has now recently been renamed to Denali, and a really exciting, really 20,300 feet, and pretty cold. It got down to about -20 at night, so pretty cold.
And did you have any experience where you were thinking, why am I doing this? Any life experiences where you felt your life was threatened?
One of my jobs, it's a great question. One of my jobs as a guide was to, quite frankly, minimize risk. And so we did everything we could to stay out of avalanche terrain and to stay out of areas with rock fall or places that you might fall into a crevasse, but there's still kind of these inherent risks. So yeah, every so often I would kind of say to myself, wow, this storm is getting a little strong, or man, I just don't feel comfortable in this terrain. But on the whole, we did a pretty good job of keeping our clients safe and comfortable.
All right, so taking your experience as a guide and an instructor, and now you're in the financial markets here. What did you take from that experience that's helped you navigate these treacherous financial markets?
Yeah, I like that. Thanks. So originally, I wrote this book because, as I was saying, my dad was coming on to 46 years, actually now 47 years of experience in the market. And I thought, wow, I really want to capture what his experience has been with inflation in the late 70s. And, he started in the late 60s with the bull run from 80 to 98. And he had all these great kind of tidbits and anecdotes. And I thought, what a fun vehicle to be able to tell mountain guiding stories, to kind of pull those out and tell his story, and that we could use this as a reference guide for our clients. But it turned into really a discovery of a philosophy, and the philosophy was really what you asked. What did we combine from my career as a guide and in the financial markets? And it comes down to this. I really believe this, that there are technical issues and there are human issues. And it doesn't matter if you're in the worst rescue you've ever been on a mountain, You need to get the technical systems right. That's the foundation. But the real care and comfort of your clients comes in kind of the soft skills. It's like the hard skills via the soft skills versus the soft skills. Framing the issues, letting them know they're going to be okay, boiling water and keeping them warm at night. And I know it sounds a little pedantic, but honestly, in the middle of 2007, 2008, when the markets were tumbling around us, we needed the technical systems in place, right? We needed good money managers. We needed well-diversified portfolios. We needed all of those things in place. But our real job was to kind of frame what was happening. Yes, we'd been here before. Yes, this is something we haven't experienced to this magnitude in our lifetime, but here's why there are certain fundamentals that we think are going to bring us through this. And so it really comes down to kind of the soft human side from both the mountains and the markets. That's really the learning experience.
You couldn't have set me up any better for my next question here, Jay. Investment style. I mean, technical analysis. Obviously, you need to pay attention to the charts. Fundamental analysis. What's actually going on with the companies and the economy. Would you say it's a 50-50 split? A little bit more skewed toward the fundamentals. How do you approach the markets?
Yeah, it's a great question, and it is a split. We use both technical and fundamental analysis. I would actually describe my investment style as fairly boring.
Okay.
Because we take such a long-term orientation. We really, and I talk about it in the book, I don't like to invest money in equities for less than 3 to 5 years, because I don't think that the value of those equities will be reflected in their prices in the short run. So, yeah, we probably focus a little more on the fundamental side, although we have some great technical analysts. One of my dad and I's philosophies that we developed, really, and it's not something we actually developed, but we learned from other investors, was a fully invested style. So no matter if you're going to change out of a fund, if you're going to change out of an equity or a vehicle, you have to have another vehicle to go into. And we really believe that all of the statistics about missing the 5 days, missing the best 10 days, those are all really true statistics, and we practice a fully invested style.
What about, the charts? I know you can have people you can rely at your firm, but, you got to take a peek at the charts every once in a while. Do you have any technical analysis techniques that you tend to favor?
Yeah, well, so, I think most of our technical analysis techniques are pretty basic.
Okay.
In terms of kind of support and resistance. I will say this, we like to think that being a little bit contrarian, and charts help in this, it is a good thing. For instance, most people look at the recent past and they project it into the future. Most people say, "Oh my God, that whoever is in political power, this is terrible. It's going to keep going." Or, "Oh my God, this market is dropping and it keeps going down. It's going to keep going down, so I should get out." And our feeling is that's never the case. That the mistake is taking the recent past and projecting it into the future. What we really believe is that most things regress to a mean, and we can use charts to kind of buttress that. Yeah, that's kind of the overarching philosophy.
No, that's interesting, contrarian. All right, so do you, and I don't think you do, but do you employ any hedging strategies if you're fully invested, with the futures or options or puts or something like that, or just not worth the cost?
Yeah. Well, we do in that we'll often rely on separately managed accounts to do just that. But I would say our major hedging strategy is the asset allocation that's fully diversified using a fixed income component and an alternatives component. I do like certain sectors for hedges. I do think that there are some good strategic bond funds out there. I do think that one sort of hedge, as we all keep saying that interest rate rises are approaching, and I've been saying that for the last 5 years, and it hasn't happened. So there's an experience of looking back and projecting to the future. But one of the things we use to generate income, we like the master limited partnership space. We like oil and gas pipelines. I think that especially in the recent market that oil prices have gotten pretty beat up, and a lot of these MLPs lock in kind of long-term contracts, and their fundamental businesses are good. They're not only transporting oil but natural gas, and they're giving off a pretty nice dividend. So as a counter to our equities in the portfolio, that's our hedging strategy, using short duration fixed income, using master limited partnerships, using those type of things.
And how long you been managing money with your dad?
Just over a decade.
Decade. So so are you guys? Do you guys just sweat it out during the financial crisis there, as far as being fully invested?
Yeah, we did. Our philosophy was, if we got the asset allocation correctly, then our clients could ride out all markets. And out of about 180 individuals and families we serve, we only had maybe 2 people come to us and say, you know what, this violated my risk tolerance. We need to change. And we did, with the understanding that going forward we wouldn't change it back because we weren't timing it. The key for us is to get the asset allocation right first so that you can live with it in all markets. Yeah, that's a good question.
Any clients that like to short the markets?
Every so often.
Okay.
Every so often we'll get clients that, and mostly it comes from, how do I put this? Maybe inaccurate information. They see something going on with Puerto Rican bonds, or they see something going on with Greece, and they want to short Europe. But we really try and guide them against that. In kind of this long-term philosophy, my feeling is that earnings and inflation, price earnings values, those type of things over the long run get reflected in stocks and in portfolios. And so I really don't like to play the short game so much.
All right.
It feels a little dangerous.
We're at
an avalanche.
Yeah. Going back to your mountaineering experiences here. So we're at an interesting juncture in the markets here. We've coming off the all-time highs quite a bit. We had the flash crash. We recovered. Kind of looked like we were out of the woods, but we came back. We're in a trading range here. Are there any sectors here that you're using this pullback in the market to perhaps accumulate some long positions?
Yeah, it's a good question. I like the idea that there are some broad themes that kind of are reflecting themselves in this pullback, and they're a bit of value themes. So I think that the consumer balance sheet looks really good right now. Corporations have a ton of cash, and they could start a capital expenditure cycle. And so things like the financial industry, which has been beat up pretty well, obviously biotech, lower fuel prices, I think that's kind of a broad theme.
Mm-hmm.
So, again, things like master limited partnerships, things like investing in the energy economy, I think, in the next medium to long term is really going to pay off. Is it going to pay off in the short term? I have no idea. I can't tell you. Yeah.
Okay. Just a couple of other questions coming out of the chat here. With the asset allocation that you had in the financial crisis, I mean, were you able to have a little bit less than that 20-30%, haircut that we had in the market? Were you able to have a little bit less of a max drawdown during the crisis?
Sure. Yeah. I mean, that crisis was unique, of course, as you know, that even typically when equities are down, fixed income's up a little bit, and at least there's some type of yield to pull from while you're waiting for your equities to reconstitute, especially if you're like a lot of our clients living on a fixed income or retired. If we buy into the efficient market hypothesis that an all bond portfolio is not as good as a portfolio with, let's say, 30% stocks and 70% bonds. So as long as we had some mixture going into, again, fully invested in both bonds and equities, as long as we had some mixture, we really were able to protect our clients. And we didn't do it with a lot of alternative strategies. We did it kind of through the basics. Like I said at the beginning, it's a boring style, but it works as long as you're patient and, yeah, that's it.
Okay. Any sectors you're kind of avoiding right now, or maybe you're hoping for a little pop up here in the market, to get out of? Or, I know you don't short, but any sectors, maybe the oil sector, is there anything here that you're a little tepid on?
Well, I will say, I think there is a ton of, and it's a big sector, obviously, but I think there's a ton of risk in long-term fixed income. It really worries me to have a 30-year bond. Interest rates are going to go up. They have to. And it's not necessarily a bubble, but it does feel like shortening up duration, shortening up maturities, being very careful in how there might be more risk in the fixed income sector, in the medium term than there is in the equity sector. So, yeah.
All right. Great outlook on the market from Jay Hack. He's a certified financial planner with Hack Wealth Management of Raymond James and Associates here in the Motor City. We always like having people from the area on. Jay, thanks a lot. Great input. We'll speak to you again soon.
Thank you so much. I really appreciate it.